Okay, we ready? Okay, wonderful. Well, I get this is an official meeting, I guess, since Commissioner Bell and I are both here. We have not done one of these forever. So I'll call this meeting to order at 3:02 p.m. This is exciting, our first meeting with RVK to go over retirement stuff. So super happy to have you with us today. And I think we'll start with just a quick round of introductions since you are new and anyone watching this video later would probably like to know. So obviously Erin Scartell, County Commissioner.
Dave Bell, Sonoma County Commissioner.
Okay. All right, thank you. Okay, are we, it looks like we're recording, so we're all set to go. So I don't have a printed agenda for this meeting, so my understanding is that it's really your meeting at this point to share with us whatever. So unless someone else has an agenda to give me other guidance, I'm actually going to turn it over to Kevin so he can share with us what we're up to with RVK.
Sounds great. This is still your meeting and your time, so use the time how you want to best. I have some things that I think would be great to cover today, but want to go down tangents and rabbit holes or switch topics? Let's do it.
Okay.
I will, I have a healthy materials packet here, really a few pages that I think are, but because this is our first meeting together, got a performance. In the interest of time, I'll probably and then some observations about the portfolio and potential next steps and how to, as well as a review of the investment policy, which I think is most important. Okay, so I'll walk through a couple pages of the performance just so you all can see kind of how this might be different than what you're used to seeing and how to does look a little.
Okay, great. Sounds like perfect place.
We'll start there on 13. So this is kind of just a dashboard of your portfolio. On the left-hand side, we've got all the investment manager portfolio. You see at the very top there, your total value as of just shy of $100. On the right-hand side, we group these managers into asset classes and then compare those allocations to your target allocation that's specified in your. This will be something we talk about later, but we do see on that chart on the back, you see some pretty big differences in terms of what's in your policy and what's in your portfolio. So we will want to take a closer look at that. So my initial take would be that it seems like the policies may be a little late, and so just wanting to make sure we update policy so that it's a little. Very bottom of the page here, you have just kind of a very high level summary of activity this year. So beginning market value, 107.5 million. We've had relatively flat cash flows, net inflows of 26,000, market gain loss of about 12. Responding to that. Through the first 3 quarters. The next slide on page 14, I won't spend too much time. This is just that chart broken out by month. So if you wanted to see what your cash flow activity portfolio did in any particular month, just a good little. The next couple slides I think are important and will kind of tie into bigger picture of what we might. So page 15, this is showing your allocation amongst assets compared to of other public pension plans, roughly around your size, so fewer than 250 assets. So you're going to be kind of right in the middle of that. There's going to be some bigger, some smaller. And so just a couple observations from this. You have the core portfolios that group in there. The peer group is kind of those different shaded bars. Down below, you have those headers and the line. And you'll see that the first number there, the allocation, so for US equity, right, 7.9%, that's your allocation to US equity. That number in parentheses is your rank amongst the peer group in terms of how is your exposure to US equity compared. So rank of 1 would be you have the most US equity. That peer group, a rank of 100. But for US equity, you're kind of right in the middle. And there isn't, this page you don't necessarily want to or technically possible to rank one in each of these things. This isn't necessarily to say, oh, we're the best at investing in US equity, but it's just giving you a sense of how your allocation compares to peers. And a couple things that stand out to me, your international equity, which is that global US equity, you have basically 91% of other public pension plans have more international equity. That is another observation we have, is that you have a very heavy tilt towards US equity, which for the most part has worked out with the exception of a couple of years, this being one of them. So one of the things that we'll probably look to correct in the coming quarters is let's maybe just bring that balance a little bit closer. The other thing I would note that isn't fully captured here, this is a much longer discussion, but just to introduce it, is you don't have any private asset exposure all in your portfolio. Markets, right? You know, you've got liquidity for all the assets that you sell for some reason your whole portfolio. That's it. But you do have that liquidity. You do, though, give up in certain asset classes. Real estate might be structure another. Some private debt instruments might. There's actually quite a bit of value added in private market exposure. It is a little bit more complex. But when I look at your plan compared to peers, most peers at your size, even smaller, have some level of private asset exposure, whether 5% or 20%, some level of exposure there. And we'll talk more about how we determine if that's even right. This isn't something that we just want to say, oh yeah, let's just, your peers are doing 20% in private real estate, so you should do it too. It's a much more thoughtful process there. But just some high level observations based on where asset allocation compared. On page 16, similar looking chart, but we're measuring your returns compared to peers. I know this is one of the things we mentioned back with you. But one of the things that we would observe is that portfolio has frankly under and ranking versus a peer group is not public pension plan, right? Is not the final determinant of success. Final determinant of success is, can you make your benefit? Right, so that is goal number one. That said, I think looking at peer ranks can give you a sense of what others are doing similar in size to you. And when I look at your pension plan, I don't see anything. You're not ultra conservative or ultra aggressive. You're somewhere in the middle. And just based on what your allocation is, I would have expected to see returns. So you see on the 5-year number there, your plan ranks in the 92nd percentile. So you underperform 92% of other pension plans size. And the allocation that you have is pretty well reflected in that total fund custom index. That's what your previous advisor was using as your total fund benchmark. We'll have some recommended changes to that, but did a pretty good job of capturing your rough exposure to equity bonds. You had just kept pace with that benchmark, would have returned kind of 50th percentile, which is kind of right where I would have expected to see this portfolio based on how you're stocks and bonds. But as we'll talk about, some of these more extreme positions that you've taken, this advisor recommended, I think have caused some underperformance. On the next few slides, and I won't walk through every, just to give you a sense of it, looking at top line numbers, pretty similar to the numbers we just looked at, total returns versus the benchmark and peer group. And then we have returns by asset class. Your previous advisor was not able to give us any historical information about your, fortunately, custodian was, so we were shy of 10 years of total fund data from your principal. So by the end of this year, we'll have a 10-year number back. We obviously, are showing an inception date on the back of January 1st, 2016. We know that the plan goes back farther than that. We just don't have to find a way to get it. But the advisor said that they did not have it, which surprised me, but in terms of trying to source that historical data. So they also did not have data for composites. We started calculating this year, so that's why for like equity, US equity, and asset class composites, start date of January 1st of this year, because we don't know about trying to get every single bank statement going back 20 years. It would be hard. Equity.
that, but
We work with principal quite a bit, and our understanding is a lot of that legacy Wells Fargo, because Wells Fargo merged with principal, all of those Wells Fargo employees just moved over out of principal. So it's a lot of the same Wells Fargo folks, but when they merge systems, some of that very, very old somewhere. Quarterly returns, month. That's,
never throw it.
I mean, as long as it's good data that we can say like, yes, this is accurate. System.
So I find
Yeah.
just a little bit too, maybe kind of like, and then.
Yeah, I mean, yeah, for us, it would need to be sequential, so we. Second streak to be able.
So Sean may have your
Well,
back
I-
on this one. She may have all the history from forever.
You got it, we'll show it.
Perfect. Thank you, Sean.
Then we list each of these managers, and this is where I think some of the numbers you see may look a little. This presented may look a little, so just using this top manager, JP Morgan. The numbers on that blue line that are in, those are the returns that you have experienced adding that fund to your lineup, which was in February of 2. The numbers that you see on like the 5 and the 10 that are italicized, those are what that mutual fund returned over the 5 and 10 year period, but you've not been invested for that. To show it, I want to distinguish what you've actually experienced
Oh,
versus
okay.
what has experienced. This report showed just didn't make that distinction, and the inception date shown was the mutual fund inception date, not. So I just want to distinguish that when you look at that right-hand inception column manager, that is the returns those are the returns that you have actually experienced. Having been added to your. But we show a benchmark and each of your funds across asset classes. In the interest of time, I won't walk through all today, and I think bigger picture will get back. So happy to answer any questions so far. Otherwise, we can move to some.
Yeah, I'm happy to move to the bigger goals and then I can go back and poke at
Yeah,
this when I have time.
So that's all the way on page 6. So we have about a half dozen observations, and some of these are certainly shorter term. The first one we'll try to address today through the policy. Some of these are, I think, are more still short intermediate term that, assuming we still have quarterly next year, I think could very easily be addressed by the end of 6. And then some of these are maybe a little bit more longer term, just keep in the back of our mind. Actions that needed. So the first in this green box here that I mentioned already, there's a bit of a mismatch between investment policy statement and the way that we view an investment policy is that it should be a very strong document. You should be able to pick up your investment policy and say, I have a pretty good idea of how this portfolio is invested. May not know the specific investment manager to use, but I should be able to say, yeah, they're probably about 60% equity and 40% fixed income. When I do that, I get a little bit surprised because you have dedicated real estate exposure, you have energy exposure. While technically those are equities, they trade a lot different, but significantly different return characteristics than the rest of the stock market. So that's something that we would absolutely recommend. See of saying, hey, we are making an active decision to trade or invest in the publicly traded is this percent. So that's kind of the main takeaway from the investment policy. In terms of the rest of the language, I think it was what I would say is spirit of it was good. There's certain sections where we'd like a little bit of specificity in terms of responsibilities of committee, advisors, managers of the custodian. Clearly lays out, this is what is expected of each of these parties. And some other language, as we move to the portfolio itself, I would say we would deem to be tactical positions. And so when we say tactical, we mean significant overweight positions to certain areas if that is a large deviation from kind of broad market. And so a couple of those are within your equity portfolio. You have a large overweight equity. Recommend that all of our clients who are US based, which is have an overweight to US equity, but general market weight for US versus international is about 60-40, 60% US, 40 international. You're at about 85-15. So you do have a pretty significant overweight there. Not saying you have to go all the way to 40, but in a year like 2022, in a year this year, international has out. So adding some diversification within your equity portfolio, balancing that to some degree, and we get that discussion at a later date. Much, I think would be beneficial. In your US equity, and this is probably the biggest driver, pure ranks, you have a significant to value oriented stock. Say value oriented, kind of divide equity stocks into value. Both is tech companies, AI, biotech, pharma, these very high growth companies that often don't pay dividends, and as it so happens, have been beating the stock market for last decade. You have an overweight to the other end of the market, which is value stocks, typically telecom, very stable, but they don't appreciate in value as just the growth. You like to see a balance of both. You have a very significant, so you've missed a good portion of the strong performance from US equity market. That is one of the things, and bringing that back into balance, balancing, not just having value managers and a growth manager. Able to, growth manager might be an expert in those kinds of stocks, but you also want to have an expert in the value stocks that are generally how we approach structuring portfolio. Having kind of some balance there, especially for a pension plan where you might get the overall level of right, which I think you have, but when you take these large positions, you're not really capturing all of adding risk, either upside or downside. The next year value stocks outperform, is going to look good, but generally speaking, you're taking a lot of risk by putting your eggs in one side of the stock market. So similar story in international portfolio. Even though it's a small piece of your portfolio, 60% of your international exposure is in emerging market weight international for emerging. So you doubled up. 30 of that is in stocks from China and India, which are high growth markets. Also very, last year China was down. This year China's up significantly. So that emerging market overweight, unlike the value piece, which has hurt you recently, 2025, emerging markets has actually outperformed the developed side of the international. But it is one of the most volatile asset classes that you can invest in. And so for a pension plan, about how much benefit is this giving us? Risk we're having. There are plenty of years where down 30% as a percent. Again, looking at these asset classes, going asset class by asset class, taking US equity and saying, we want this part of the portfolio. Like optimizing that onto international equity. Let's take a look at how this portfolio is structured, where sees and how. That's kind of I would say the primary takeaway of what I imagine. As part of that, I would just generally say you probably have. There isn't a magic number. 12. Can actually over diversify, where I have a bunch of different managers who are trying to do a bunch of different things, end up effectively kind of at an index, but you're paying, instead of paying 2 basis points for X fund, you're paying basis points X fund return. A bunch of different managers who are kind of one each other. So as part of this kind of asset class review, we would recommend and will recommend trimming down the total number. I think that should help returns in the long run, and I think it also eases the return burden. Trying to track, strategies, it's a little manageable and to understand what each manager's role. So those two things I think kind of lead into the next three, which is again that total fund. Again, number one thing we want to make sure we can do is pay our back payments, but we do want to be at least aware of how similar plans. So again, I think some of those large tactical resulted in everything we just talked about. I think we can do. I will follow your lead. If you say, hey, we want to do this as soon as possible, let's call a 2-hour meeting and let's just knock it out. We can do that. If you want to do this chunk by chunk, do this over the course of 2 or 3 meetings. That it also depends on how you want that to go. I mean, we can do it a couple of different ways where he can say, hey, we think these are the 3 managers you should use in your international equity portfolio. Or we can say, we think you should have an international value manager. Here's 5 international value managers. Here's 5 international growth managers. Let's kind of walk through each one and selection as a group. Again, I'll leave that decision to you in terms of how you want to be structuring in terms of your level of individual manager. Any manager we present to you as an option is going to be, but each manager has a. You have to make that decision right now, but something to think of.
And I think we'll want to have our third commissioner here as we make any, significant decisions, obviously. Boards over the years have done it differently, different levels of engagement, different levels of decision-making, different levels, just frankly, of knowledge and experience in this arena. So I think it'll be a good conversation for the 3 of us to have as the 3 seated commissioners to say, where do we sit today? How much do we feel like we need to have our hands like deep in the details, or not? And so I think it'll be a good conversation when we have Paul with us.
I agree completely, and just off the cuff, I would rather have a 2-hour workshop and jump in when all 3. I don't know why. I can't, in this moment, I can't imagine the advantage of breaking it.
Yeah, in terms of working with other clients, it's usually just a strength of only get everyone in one room for an hour. So that's why I would kind of agree that if that works, I think doing it all at once makes sense because of the context, each part of the.
Sure. Sure. Yeah, no, and I think that would, also be a good approach, particularly again, for Paul, it'll be his first kind of getting his eyes on all of it. And, I think I said it in the interviews, it's not my area of expertise. So if you can immerse me in it for 2 hours and I can get my brain on that train, that's fabulous. Cause as soon as I walk out, it's going to go on a different train. So, and I think Commissioner Bell has a little bit more experience and knowledge in this area than I do. So it might be easier for her to jump in and out of it than it is for me. I don't know.
So again, I think that's a reasonable goal. Next couple. The last 2, I think, are a little bit more. Get to longer. So in February, ad nauseam. In terms of that being in our view, kind of best study to do any, especially if you've never. It does take asset side and really tie it to the liability side. Because, you know, in that interview, we had not seen the actuarial report. I just
Mhm.
had a chance to connect that. And your actuarial report, I am pleasantly surprised with everything I see. I don't know how many pension plans that I work with that we as a firm actually lower their assumed rate down. That is awesome, because that is a realistic return target. There are many pension plans out there who still have an 8 or 8.5% return target, and that's frankly unrealistic. So there's going to be a day of reckoning at some point,
Mhm.
when you're not able, consistently not able. So looking at, you know, your solid funding status, again, professional actuary, but my professional opinion, that matters. Very solid contribution policy, funded, realistic return target. So I don't know that an asset liability study is urgent, but it is something I would really consider doing. We model it down to the individual participant stream. What happens if we adjust COLAs more or less, or what happens if inflation is higher? What happens in this kind of a market, that kind of a market? We really kind of stress test your portfolio and your liability, how those move. So again, something that we'd be happy to do for you down the road, but I think there are other things first, and can come back to that. That is something I do strongly advise you do at some point. But
Okay, because I feel like that's one of the key pieces for us, since we have closed the plan to new members, that at this point, we need to have that sort of stress test on it, because we are not in the place of, it'll be okay, because we got new people come in and we don't have to worry about who's leaving and when, but we really do now, you know, in a more significant way than ever before. So I do think that's something we want to do. And I hear what you're saying, 6 months, you know, down the road, a year down the road, get everything reorganized, focus there, make sure our policy is good, all of those things, and then let's just back it up with that work, maybe.
yeah, and where we would not want to recommend any significant changes to your overall risk posture without an asset liability study. So
Okay,
you might want to, you know, adjust how the US equity portfolio looks, but I wouldn't feel comfortable recommending you increase or decrease US equity by 10% without knowing the results of this study.
Okay.
We need to know how much risk you should be taking. If I were to eyeball it, I'd say you're probably pretty close from a risk perspective in terms of how much risk you should be taking, but I think an asset liability study will either tell us, yes, keep doing what you're doing, or you might need to change some things. So that's why I think it's definitely do, but don't need.
And is that something, sorry,
Oh, I'm so sorry, because we could, you would, tie into what Commissioner Starr was saying about the numbers that are truly changing. And say it, but it's like you have to aim out. Say, is it that? That point.
and we've heard that mortality rates, that our mortality rates haven't been updated because people are living longer now, so there's that. What I was wondering is, does RVK do the asset liability study?
We do, yeah.
Yeah.
It is, because it's something that we only recommend 5-ish years. But some people really want to, I would say, plans that are in more of a have financial issues, want to do it every 3 years. Plans that are in a little bit better position, maybe go a little bit 5 years, but 5 years. I will say though, had you been our client for the last 10 years and you had a significant change in the plan like this, that is exactly the time you would want to
do it. Okay.
You have a large change in asset side, the liability side.
Contributions, those are. From Sean, maybe called her and I was like. Remember, and was. Well, you know, we're so used to seeing that higher. And also two, you know, yeah, now we're up to. Yeah, so now we're at 200 on beneficiaries. The average person that's retiring out, it's not like it was back in 2004 where it's like, oh, you got a big pension at $800. We're not gonna get to 5,000 a month that we're, I mean, when we do get that new person coming in, pension benefits, benefit that is getting, I mean, basically $500,000 every month. And balance it out, you know, gosh, it was that number was bigger, so I really do, but then when it's like, please, can you go to, you know? On the pro.
I'm pleased to hear that we're, that it's great that we have 6% that. compared to-
Yeah, and you'll see it at a public compliance and do it. Because you can get pretty good data on data, show you a table of, here's your assumed rate of return, and here's, 85 other public pension plans. Their salary growth rate assumption, here's yours. So it's, not every pension plan is the same, of course, but especially on the assumed rate of return side. Who's maybe out in left field in terms of maybe not in reality in terms of, and who's maybe.
Perfect. I'm not sure which Board of Commissioners did that, but we should thank them.
And so part of that, what that'll also tell us is it'll tell us your liquid, like how liquid do you need? Can you take the liquidity? Because one of the things that private markets can do is they're not marked to market assets, privately owned apartment building, effectively the same as a publicly traded one that's in a REIT, but it's not subject to the ups and downs of the market. It's a little bit more stable and it can reduce some of the volatility in your portfolio, particularly when you have a 6% return. It can be a good way to de-risk away from risk. But we do want to make sure that you don't over allocate to illiquid assets and then all of a sudden you can't get it. So it really can help say, can you take private market exposure? If so, how much? And we'll always err on the side of being conservative there, but if the study says you could take 40% private asset exposure, I'm not going to come in and recommend you take 40%, but
Right.
it's like, okay, you can certainly take more than you have today. So that's tied to the asset liability study, but that is something I would note as a potential way to enhance returns and utility.
And is that study something that's in your services or that's something extra that we are doing?
So the asset liability study that is a one-time fee of $20,000.
Mhm.
And we don't build it into our, it's not something that ever.
Okay.
It is a one-time fee, $20,000, and we can.
Okay.
Just, it is separate.
Okay, thanks.
So those are kind of the I would say the primary observations that I would have. Any questions or comments on that?
That was my question.
Well, again, page 64, I put this together, obviously, without having met with you, and it sounds as though you're interested in, doing some of this portfolio restructuring quickly.
Mhm.
But you see on the green box today, we're going to take asset policy. I put asset allocation introduction there, but I wanted to include it. But then, I mean, really, again, and this is to your schedule. We could break this up into 3 quarters, but again, it sounds like if we get 2 hours, we could, touch on every asset class and
Sure.
knock it all out. And we're happy to do that. Just tell us when. But that, sounds all right to you, or we'll schedule. So that was kind of the work plan for the balance of 2026, but if we knock it all out at once, some other area. On the right-hand side, we kind of have a separate work plan where we've got this, big asset liability study we'll do at some point. That
Mhm.
will result in a pretty in-depth asset allocation study where we like, probably will make some changes to the asset allocation. What exactly will look at asset liability? But in the interim, before we do that, we can at least take a look at asset allocation so you're familiar with process, where your current portfolio sits, how efficient is it from a risk perspective. We can still look at all that stuff. So, if we're doing some of this manager restructuring all at once, an asset allocation study might be something we could next year get familiar with that process,
Mhm.
because a lot of what we do in asset allocation, that's half of the asset liability side. So it's a good exercise to walk through.
Yeah, and I think for me, I would feel better if we did the asset liability study sooner rather than later, and
Okay.
just understanding, to your point, Mary Jo, that we have made this big change and that you're already seeing it significantly on your side. And I think we'll all feel better once we have taken a look at that and went, okay, we understand where we are, and RVK has given us a plan that says we're okay. We can do this, over the next 30 or 40 years or however long it is that we have for this plan. So, yeah.
I mean, so the only thing I'll say is we like to get a good amount of lead time in terms
Mhm.
of, this is not a small undertaking.
Sure.
We're modeling it out to the individual scenarios, so do it with as little as 3 months notice. We prefer a little bit more just because we're doing this for a few.
Sure.
Also, I would ask if you could give us a 6-month heads up,
Sure.
in terms of, I want the results presented in June. Just let us know by the end of the year if that's something you want to.
Sure. Well, we've got to look for the 20,000 in our budget, right, Sean?
Well, actually,
Yep. Oh, okay.
it hasn't even- just the-
Well, that's good
why
news.
the equal to- No, that's been every like. Yeah, down by it. I could run it by,
Yeah, let's figure out what makes sense. If paying it from inside the plan
Yeah.
makes sense, then it's obviously it's to the benefit of the plan.
oh, excuse me, 20
I support us paying for a plan that checks all the boxes. And I agree that we should do the asset liability study sooner rather than later, not only for the reasons stated that we've changed, but also because we've made the change to RBK and we should have a baseline.
So we'll figure out how we're paying for it. And then once we know that, we'll let you know that we would like to have it done as soon as we can slot it in, probably.
Sure. And I'll work with our team on type letter agreement.
Okay. Perfect.
The scope is clearly different.
Thank you.
So the kind of one, agenda item today. Understanding that the first year, I wouldn't expect to be doing it, but I
Mhm.
think it's certainly walk through some of my made the changes that was quite a bit of, which is included. Some time with that in terms of change.
Mhm.
But on page 66, this is just digging a little bit deeper into that target allocation mismatch there. So on the left is what is currently listed in your policy. So 50% US equity, 10% international, 40% fixed income. Fixed dollar amount target, plus or minus. In the middle is really how your portfolio is allocated. And so I'm less concerned with, I mentioned my concern about the overweight to emerging market equity. I'm less concerned with having an emerging. That's international. But where I think where I would really want to make that policy is in that global REITs and public space, because are so technically equity securities, they are specialty, they have a this that's a little towards inflation hedging, they're also highly volatile. And so I would, best practice perspective, I would really out them. So it was clear to me that the previous advisor was treating that as a separate asset class, because in the custom benchmark that they were using, they had kind of a target allocation to real estate and energy, which wasn't spelled. So what's on the right there, that is really what's reflective of that target allocation benchmark being used in your report. And so really what we would recommend is just adopting that exposure, that target allocation into your actual. There is a very clear line between policy and implementation.
And so does policy change as implementation changes? I mean, I remember when we made the decision to go with the REIT, because that was while I was a commissioner, and that was our advisor coming to us and saying, so I can see the inflation happening or coming, and so do we want to do something that will make sense in that world? And so walked us through making that decision. So I think of policy as something that stands, that guides us. But what I think I'm hearing you say is, yes, and if you want to change, you need to change your policy with it.
Yeah, so that's what I would say is policy. So the way that we kind of think about it is policy should be broad enough that it shouldn't ever say like, you can never invest in X, Y, and Z. But it should say, here's what is currently allowed as investable assets and a range around that. So that the kind of extreme example that we like to use, bad actors got in charge of managing your money. Not bad actors in the sense that they're trying to steal it, but people, advisors got put in charge who didn't really know what they were doing. They would have to stay within the bounds of the policy, so that they couldn't, go too crazy. So in that sense, I think having an exposure, having clear guidelines in terms of what you can specifically invest in at this time, so that if you ever want to change what you're invested in, you can change your policy to say, hey, we've reviewed, RBK's recommendation to invest in or whatever. We can change that policy at that time as part of the recommendation. But in that interim, we don't want portfolio to start to deviate from what's listed in the policy. It's kind of how I think. So it is kind of a both.
I mean, it's kind of sideboards, but not really, because you can just move those sideboards. So if you convince us that really we should be going this direction, so as we did with REITs, we just should move the sideboards to match it.
Right, but see, not discretionary. Right, so any recommendation about investment that I make, you have to approve.
Right.
So
right.
In this case, implementation is leading policy. I would say going forward, we would expect those to happen
okay.
at the
same time. Okay, thank you.
On the following slide, again, this is but on the left, this is the actual target allocation index that your previous advisor is using. One of the things I note there in green is you see that 21% weight to that Russell 1000 value index. So that's large cap value. Right? So that's that overweight. We prefer total fund benchmarking to be a little bit more broad. So we're not recommending changing target allocation to US equity, but we're recommending you change the benchmarks that you use for each asset class to encapsulate the whole market as opposed to target. Because what your current benchmark is doing is effectively saying, I am benchmarking myself against this extreme position that I've taken, but what's not being captured in that difference of performance versus benchmark is that extreme position. Because if you were benchmarked to the broad market, you would see, oh, this extreme position that we've taken is making us underperform by 8% or whatever. So we prefer for asset class total fund benchmarking much broader benchmarks that encapsulate the whole market. So that's what we've done here. US equity benchmark is the Russell 3000 index. That's effectively every US stock that's not. International is, again, the full spectrum of international investment. Fixed income, there's no change there. Every investment grade US bond. And then real estate, just changing from kind of two. One of those benchmarks is a US REIT index, the other one's a national REIT index. We're just gonna use it. So that's how we would recommend kind of specifying these specific allocations in your policy, but then also on the benchmarking side, moving to a more neutral position from a benchmark. So that's kind of the detail on just that target allocation piece. The next few pages, kind of reflect kind of the edits that I would recommend to your policy, and following these pages is the full kind of red line edited version that's going to include every period change and capitalization change where things were deleted. But I think this is a little bit cleaner to look at. And I put some of my comments in terms of what's kind of high level, what was changed. So starting on page 69, was really pleased to see that you had proven investor language at the top of your policy. That's what we would recommend. Basically, a statute that's been adopted by most states that says governing public assets, you need to act as though you would. We just kind of took that language and expanded it to consider. So you kind of had a couple sentences in there. So no real change to the spirit of that, just adding some more clarifies that those responsible for managing the plan, whether that's me, whether section 2, this is a new section that we added, just clearly outlines the committee's responsibilities. And then did something similar in section 3, outlined our responsibilities. Section 4 outlines the custodian responsibilities. Much of this language was already for the custodian was already in your policy in another section. We just kind of moved on just so it's kind of section 5 is investment objectives. You had some of this language in here. We, I think, clarified and added a little bit, made it very clear that the number 1 is to your beneficiaries, and added goals around meeting actuarial assumed rate, which the language was in there, but the rate itself was not. So we did clarify that rate is in fact 6%. Should you ever change your rate, you would want to make sure. And then did the last one, the kind of least important of those 3, is you want to outperform the benchmarks that you set, and generally rank in the top 2/3 of a peer. That's a pretty reasonable expectation from a peer perspective, based on your overall risk tolerance. If you were a plan that had 90% fixed income, you probably wouldn't expect you're probably going to be at the bottom, but 90% fixed income, that spot from a but I think top 2/3 is a pretty reasonable goal to expect overall. On page 72, you'll see that target allocation table that we would recommend. One of the things that we did was in that allowable range, we did tighten those up a little bit for 2 reasons. One, I think it will force you to rebalance if someone falls asleep at the wheel and you're never rebalancing, and all of a sudden you're 10% off targeting to be. Having those ranges is going to say, oh, we've breached policy. We are now mandated by policy to rebalance. So we've, again, tightened those, not so much that if the market has a really good week, we all of a sudden have to scramble to rebalance, but it's more so here to make sure that we're staying on top of it and we've actually added rebalancing. There was previously no in terms of should you rebalance. Added some recommended. Your previous advisor, best I could tell, had kind of outsourced manager monitoring to a third party where they had, I think, purchased a service that was kind of ranking the managers, giving them a number score. We don't do that. I actually don't. Reading through that kind of criteria, it's a lot of the same stuff that we look at. Just do it ourselves and don't kind of assign this manager's a 7 and this one's a 6. We kind of look at a couple things, primarily, are they underperforming? If so, why? And that's when we start to look at all the, Sharpe ratios and all. modern portfolio statistics.
Mr. Sal.
So we have, we basically rewrote that whole section because we don't pay for that service, so we can't use that.
Sure.
But I think that the spirit of it again is unchanged. We basically said in investment management guidelines, this is just laying out some rough guidelines for each kind of investment where you're an equity manager, you can't have 15% in it. You have to have a diversified portfolio. You're a fixed income manager, you have to be investment grade. You own junk bonds. So there's kind of some guidelines in terms of what these can buy. But as it relates to monitoring process and expectations, section 7, kind of laid out expectations for investment managers. So outperform the benchmark over a 5-year period in equities, rank above median compared to a peer group of managers over a period. And if they fail that, the watch list criteria would say, if for 3 quarters in a row, your 5-year return rank is below median, you go on watch list. Watch list doesn't mean you get terminated, but it means we're going to talk about you at every meeting until you or terminate. And so sometimes there are very understandable reasons why a manager might underperform. They could have a certain investment style, and that style could be out of favor. We're seeing that in small cap US right now, where you are the best performing small cap US companies are the companies that make the least amount of money. Least profitable you are, the better your stock is done. The more profitable you are, the worse your stock is done. So we tend to recommend small cap managers who buy companies that have money. They're not doing very well right now. Don't think that will last, but we have a lot of small cap managers who are ending up on watch list as a result, and we're not recommending termination because we feel pretty good about that in the end profitable company. So watch list to us does not mean you've got 3 quarters to get off, otherwise you're out. It's okay, no, let's make sure that we as an advisor and a committee and staff understand why you're underperforming. Is this something we expect them to be able to fix? Did 3 of their analysts leave? That's why they're underperforming. Okay, that's probably a bigger issue. Are they being investigated by the SEC for fraud?
That's an issue.
That's probably an issue. But our small cap manager or our small cap stocks who are unprofitable leading the market, and you're underperforming. Okay, that seems like something that's probably pretty reasonable way to underperform and might correct. So that's generally how we view the monitoring process. We will also put a manager on watch. Their performance is great, but they have one of those issues. And we get that information by, we have 24 people in research whose only job it is to meet with us. So if we see an issue like that come up, we will, team on the phone with them. Oftentimes we get a heads up that some news is going to break before it happens, and we just can't talk about it until. But we're generally going to be on top of it. If it is kind of one of those big issues like an SEC violation or the single guy running the fund retires, you're going to hear about it from us before the next meeting. And this is a concern. We recommend doing something immediately, even if they're not ever on the watch list. So that's kind of how we approach it, where it's a little bit less formulaic. We still want to look at numbers. We still want to be quantitative, but we do want flexibility. So I know there's a lot of text here, and there's no way you could have possibly read it while I was talking. So
No.
I want to make sure that you have some time to spend reading through this language. Again, the pages 78 and onward, that's going to show everything we deleted, everything we added, everything. I don't think,
Oh, gotcha.
from my perspective, I didn't remove anything from your policy that I felt was core to the policy. Some instances it moving something and adding slightly different language. Sentiments that kind of repeated throughout the policy where I think it's in one section. So things were moved around, so there's quite a bit of there, but please take your time with it, and next time we meet.
Perfect. Thank you. Yeah.
For 3 minutes.
I know. I think this was a 1-hour meeting today.
Yeah.
Woo! I think we, we filled that 1 hour and
Yep,
easily.
that was everything I wanted to, so.
Thank you.
Yeah.
This was very informative. Thing in the hour. That's a lot of information to share in an hour. Thank you.
I drank a lot of coffee. That helped me talk fast.
Well, you did well. You did well. We do have 3 minutes. Are there any questions? Committee? No? Mr. Bell, any other questions or comments?
Just in the immediate future, when do we meet again? What's the very next step?
So what I think I heard is that we would like to, we'll circle Paul in and see if we would like to get a 2-hour meeting on the calendar, and that would be working with Debbie and our schedules to see when we could get 2 hours put together, obviously with your schedule as well. So we'll probably have Debbie reach out to you with our schedules in front of her and see what we can get on the calendar. And then I think the other piece is for us to determine budgetarily, and I think Mary Jo, is that you? Okay. Perfect. And then we,
Sean might help.
right, so Mary Jo will help us figure out if we can pay for this within the plan or if we need to figure out another budget solution. So we'll sort that on our side. Once we know for sure, then we'll get in touch with you about the timeline for the asset liability study so that we can figure out when that can happen. And then thank you, Sean, for all of the archives that the Treasurer's Department keeps in case you ever wondered why. We're maybe about to find out.
Yeah, returns back to January 1st, 2016.
Okay. I'll see what we,
Yeah, and we went to Wells Fargo February of 2012. Actually, it was Valentine's Day.
memory.
Yeah.
Frighteningly so. The fact that you know that, yeah. Okay. So we'll also see if we have those and we can get those to you. So I think that kind of lays out our next steps. Does that sound good?
We will help you any way we can.
Okay. Well, with that then, again, thank you again for being with us, and we will adjourn at 3:59. Look at us.